Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, December 11, 2015. And you're looking at a daily chart of the SPY, and it was quite a day out there today. Markets got hammered, and remember for the last couple of days, I was explaining how the erratic behavior intraday that the market was experiencing is generally a sign of a larger move coming. And I probably harped on that several times this week, and this was what I was talking about. You don't always know which way it's going to go, but there was a pretty good indication when we closed below some of these levels. When we closed below the green candle here at 205.93, I said that was trouble, and here we go. So we had a nice big healthy down day today, and we came right into the first target. Well, actually, we came into the first two targets. In fact, if you remember for the last week or so, or more than that, I was saying that this is your zone. This is the target zone. And interestingly enough, I had a couple of emails today saying, should we buy the market? It's in the target zone. And my response was, no, don't buy the market. It's very weak. And we didn't see a healthy bounce or anything like that off the target, and we closed poorly, which means there's more downside coming. That's at least the way I read it. It's not a guarantee, but that's what the probabilities tell me, is that there's more downside coming, and I would suggest that we're going to get to the secondary target, which we discussed last night, of here. Remember, I put in the 200 line, and then the 199.30's been in there as a heavy, heavy line. That's going to be really, really good support. But that seems to be, at least in my work, where the market wants to go. We closed poorly today. But let's just take a look at the hourly chart. Actually, we'll look at the 10-minute chart first. And you can see here, first we came into the 203.25, got a little bounce, cut through it, and then we had a little bit of a rally up to over the 204 level. So that level proved as an intraday level to be good. And if you're an intraday trader, this is what you do with these levels. You trade them. And then the market came back down, tried to fight the 203.25 again, and then went right to the 202.21. I mean, these levels are very, very solid from a mathematical perspective. Okay, look what happened. Okay, we hit the level. We traded on it for about a half an hour. And then we ripped higher. Okay, we went back up to about 203. And then we came back down. Again, tested 202.21 again. And then we went up past 203. Failed, came back down, and finally broke through it. Now we're making a bearish pattern. Okay, and this is one of the reasons why I say we closed poorly, right? Even on a 10-minute basis, this is a downward move, bearish pattern. Okay, maybe we test the underside of this Monday, or maybe we just gap down lower. Maybe the futures open down Sunday night and we just head lower and right to those next targets. Okay, so even on the hourly chart, we might as well take a look at that. It's much of the same thing. We closed below the 202.21, which to me is a very bearish sign. Okay, the fact that we couldn't hold them into the close tells me the market wants to go lower. And again, just one more time, where's that lower point? The first is 200 and then 199.30. In that area is going to be very, very good support. If you're an intraday trader, yes, you can buy those levels. If you're a swing trader, a daily trader, and you're looking for a multi-day bounce, you really need to see the market put in a bottom. And the best way to do that is to look at the hourly chart and watch for a high volume reversal candle or some kind of a signal like a doji candle, and then some follow through on an hourly basis. And that'll tell you the market's trying to carve out a short-term bottom. That's the best you can do trying to pick a bottom. But don't look for it really until you get down to these levels. Most likely, there's a high probability the market wants to get down to these levels. That's just what my work tells me. We'll see what happens, but the math generally works. I mean, look at the downsloping trend line. 1, 2, 3, 4, 5 hits, and it couldn't do it, and we traded away. And everybody was bullish in this camp up here. I even drew these lines in just in case we did break through, and we never were able to do it. But the market looked bullish at that time. And everybody, the media, all the money managers, everybody you read in the financial media, everybody was bullish. We're going to make new highs. The market's going to we're having the Christmas rally. It's making new highs, no question about it. Bull. I told you back in May that this was most likely the high for the year. And we kept talking about that I believed, and I've said this for months, that I believed that the high was in for the year, and most likely it was going to be a multi-year high. Now, I don't know whether that's for sure or definitely going to be the case, but in terms of what I believe, I think the high is in for a while. I've been saying that for months. I still believe that. Even when we get up in these zones, I always tell you I'm suspect that we can get up past this area because there's a lot of resistance up in this zone, and that proved true one more time. We're going to get down here. The market will have a bounce. And remember what I said also. We talked about this several days ago. I said about the tail wagging the dog. The market will most likely trade into the Fed meeting. Down, I should say, into the Fed meeting, because it's the tail wagging the dog. The Fed is going to find it very, very difficult to raise interest rates in the face of a market that's down, just like we sold off in the last week, okay? From the 2nd of December, we were up at 211. Today, we're at 201.88, okay? That's 100 S&P points, give or take, okay? The Fed is going to have a difficult time discussing raising interest rates, which is a negative for the overall economy any way you skin the cat, okay? Even though they'll minimize it, but it is. Therefore, I find it hard to believe they'll actually do it. And if they do it and the market's down, you may see some kind of a relief rally. Tuesday and Wednesday is the Fed meeting of next week. It's also options expiration week. You can expect some erratic behavior next week. I wouldn't be surprised to see us test down at these levels leading right up into Tuesday. Maybe we trade down there Monday or early Tuesday, and that may present a buying opportunity if we see a reversal. We'll see. We'll have to take it one day at a time, one candlestick at a time. But let's go over to the IWM. Obviously, the IWM got thumped today, down almost 2.5%. The S&P was down, or the Spider was down 1.93%, about 2%. It was down about 2%. By the way, let's go back to the Spider. I forgot to talk about volume. I wanted to point out volume to you. Look at the volume today down here. I don't know if you can see it that well. The volume was 210, almost 211 million shares. Remember this up day, and I said that was on good volume, and that was on volume of 193 million shares. So you surpassed the up day today on the down volume, and you can see on days when we have huge selling pressure that the volume spiked higher. 211 million shares against a 90-day average of 112 million is big volume. Okay, so this is telling you either it's normally exhaustion or capitulation, or it's a sign of more downside to come. I think it's a sign of more downside to come. I think we'll have one more day maybe where we see even volume surpass today, and that would put us down in this zone. We could even pierce through it a little bit. It wouldn't be surprised if we did, but we'll know the reversal when we see it. Let's go back to the IWM. So look what the IWM is doing, okay? The IWM is trading far and away from the upsloping trend line drawn in from the monthly chart, okay? You can see this. This monthly chart, as we know, was very, very good support for a long, long time, okay? And then we challenged it in November, and we broke it in August, September. We broke it in August, traded down again September. We tried to rally back to it in October, and we cracked it in November, and then we just traded away from it in December. So we're pretty far away from it now. I can't see December closing above that line. I would be shocked if it did. But So there you go on the IWM. So the IWM also had extremely heavy volume today. Heaviest volume day in quite a while. The last heavy volume day like this was back in here on this up day, which the volume was 65 million shares. Today it was 52 million, 52.5 million. So more downside coming, I believe. That's in fact, with the IWM, it's pretty obvious that the market wants to fill this gap at 110. What's the exact number? The high was 110.63. So we might as well put that number in, 110.63. Okay, wow, I almost hit it on the nose. 110.63. All right, we're going to probably fill that gap on Monday or Tuesday. That would be my take. And you'll get a nice reactionary bounce off that gap intraday. You should anyway. Transports got thumped. Look what happened. As soon as we broke down, we talked about this for a long time. As soon as we broke down this channel, okay, this was the channel we talked about for a long time, several weeks, okay? Soon as this channel, the bottom side of this channel broke, look what happened. It took 1, 2, 3, 4, 5, 6, 7 trading days once we broke this channel to go down 500 points in the transports. That's a big move. You can see we're coming, let me go to the weekly chart. You can see what we did was we're basically into, it didn't look like that on the daily. That was interesting. But we're into this down-sloping trend line back to it. Remember, we had a bullish pattern that I talked about for a while. I said this was an up move on the weekly chart, and it was consolidating. And it was getting ready for another up move into this purple line or the 50-period moving average. We talked about that. But what happens is, and this is the same channel that we were talking about on the daily chart, when a pattern fails, okay, it fails in a big way. It generally goes at least equidistant in the opposite direction as it would have went in the up direction in this case. So the bullish pattern would have taken us up to this level, okay? And since we failed, look what it did. It took us down to about an equidistant level so far. I think there's probably more to go. I just find it interesting, and, you know, you don't have to be a rocket scientist to figure this stuff out. I hope you guys are learning because, you know, what I do is not necessarily that difficult. And the more I talk about it and the more you pay attention, the more you can see how the markets trade. All the charts do the same thing over and over and over again. Let's quickly look at the junk bond index and look what happened. Well, this is the weekly chart. Let's look at the daily. The daily chart got thumped again, down almost 2% on the junk bond index. We've been talking about this on and off for a long time. Talked about it a little bit this week, probably 2 or 3 times, that this was melting away, and it's directly as a result in large part of the energy sector and all the companies that lent the energy sector money in the last several years. So they're going to get hit hard, and that's why the financials got hit hard and continue to get hit hard as well. And not necessarily as much in your JP Morgans and Goldman Sachs's and Wells Fargo. They're not the ones you have to worry about. They can absorb losses to the magnitude that some of these master limited partnerships and exploration companies are going to take. It's the second tier lenders that are lending at high yields. That's who they borrowed from. Those are the ones that are going to get hit the hardest. So, watch the junk bond index. It's definitely a great proxy for the stock market. And if you can see, the junk bond index started melting away before the market did. Okay, so, and it was weak while the market was rallying, which told you that the rally was a phony rally. You know, so if you look in here, okay, this was in the November 18th. Let's just use an example and pick out November 18th. Where was November 18th? Right here. Okay, so the market was rallying from November 18th to December 2nd, 1st or 2nd, okay? And what was the junk bond index doing from November 18th? It was melting away. It made a down move, bearish pattern, and started melting away. And that's when I started mentioning it on and off again, was that it was melting away, and it's generally a proxy for the overall market. So you can kind of put that in your notebook and remember that, because on the upside, the same thing will take place when the junk bonds begin to rally ahead of the stock market, along with several other things. I use it like a proxy, similar to the IWM and the NASDAQ composite, by the way, incidentally, which is down over 2% today. So everything got hammered across the board, as you would expect. Let's go over to the gold market. And gold had an interesting day. So I want to go to the hourly chart because it's doing exactly what we mapped out. Look what happened. We came directly into the 618 retrace that I've been talking about all week long. Okay, we hit a low of 1061 today. The low was exactly 1061.70, and the 618 retrace was 1061.83. Okay, so that's a direct hit. And that still maintained our bullish pattern, right? We had the up move, we consolidated. I told you that as long as we maintain the level on an hourly chart closing basis above 1061, which was the 618 retrace, that was a good level. And look what happened. We played around with it for, when did this happen? This happened at 6 o'clock in the morning up until 9 o'clock in the morning. And then at around 10 o'clock in the morning, between 9 and 10 o'clock in the morning, we started to rally and the market started catapulting, and we got all the way up to about 1080. What was the high today? 1079. Okay, so gold is going higher. This is what this chart is telling you. If you want to wait for a solid close above, 1080, 1082 in that neighborhood, that's fine. But gold is a buy as long as we don't fail here and come back down. But you can use a reasonable stop. Gold is a buy. If you want to wait, you may not get the opportunity because it can open up on Sunday night. Who knows? But above 1080, 1082, gold is going to be a buy, and it's solidified above 1085. You're probably going to go to 1200. Scratch that. 1100 in short order. Now, what happens at that level, we have to see how it reacts and how it gets there and what happens at that level. But from here, if you're a futures trader, there's a lot of meat on that bone. You need to understand that with that much meat on the bone, it's worth taking at least a contract or two, if not more. If you're a decent-sized future player, then you have a lot of meat on the gold bone. Unless we fail, I don't see that happening. I see the reaction off the 618 as a very, very bullish and positive sign for gold. Silver, on the other hand, did not necessarily have the type of day that I would have expected. It did not have the type of reversal intraday that I saw in gold, although it will normally follow suit. But just to make mention, because I know there are some of you out there that like to talk about, or at least watch the silver charts, understand that I'm not seeing the exact same thing, although I do believe it'll be pulled along when gold rallies. I think silver will ultimately rally. But silver has a couple of other dynamics. It's more, there's other discussions that go on between gold and silver. Silver has the discussions centered around the economy because it's used in a lot of industrial applications. So if the economy is weakening, they like to talk about silver as not needing enough or more silver for production of various things in manufacturing that use silver, the automotive industry and others. So when the economy begins to weaken, the discussion tends to pull silver down with it. Gold has other discussions such as the fear trade, such as the dollar, such as who knows what. I don't really pay attention to any of that stuff, as you know. I'm just telling you some of the underlying reasons that other people like to believe, and some of them, at least in the short term, become self-fulfilling prophecies. Whatever the discussion is with gold, I don't know what the media's reason was that gold bounced off the 618. They don't even know about the 618. All I can tell you is it's acting bullish. That's all I need to know. The market going back to the stock market for a second, all the reasons came out of the woodwork today about why the market is under pressure. It was China again. It was this. It was that. Who knows what it was? It doesn't really matter what they say. I'm giving you the targets. I told you the market was looking weak. Don't listen to the media. They come up with the reasons after the fact. Believe me. The reasons they cited today, they weren't talking about 2 days ago, okay? So the reasons always come after the fact. It's a bunch of bunk or nonsense. Okay, let's move on. That's enough for the soapbox. Let's move on to, oh, and by the way, you know, just as a interesting note, GDX, which I don't talk about a lot, but I know some of you like the gold miners, GDX had a positive day today, only up 19 cents. But the point is that that's also, especially on a day when the market got hammered, okay, because these are stocks after all. The gold mining companies are stocks. And the fact that GDX was up today is somewhat of a proxy. And look at this reversal and bullish pattern on the hourly chart, okay? You have this huge reversal hourly, okay, and then putting in a sideways bullish pattern. This market's going higher. Okay, you can trade this up to probably $14.85 to $15 in short order and potentially higher. Hopefully higher. When gold rallies, this is going higher. If we look at the daily chart, that's just on an hourly basis. On the daily chart, we probably get up into the 16 to 1650 area if gold rallies to 1100. That's my take in the gold miners for what it's worth. Okay, let's look at oil. Crude oil got drummed again. And look, it just continues to melt away. There's nothing good here. There's nothing to see. You will get a reversal. You will get a, the sentiment has become so bearish that you're bound to get a bona fide reversal at some point. Now, we talked about 36. 36, didn't spend much time at 36. I also mentioned 35. It's not like I made it up out of the blue. It's an obvious, middle of the road round number, 35. It sounds like a good number. Did we get there today? I didn't even notice. 35.16. So, honestly, I'm not sure where this stops. At this point, you really have to just wait for a reversal and follow through in order to be able to play anything to the long side. I would just stay away, let it fall, let it happen. You need a high volume capitulation day with a reversal, and that's the only way you can play crude. And we just, it faked us out a couple of times. For example, the high volume doji candle could have been a reversal. We did have a 1 day, half a day wonder, but it failed. We're going to need to see that with a high volume reversal and follow through. It's going to be very hard to pick the bottom in crude oil. That's just the way it works. Okay, let's go over to the, let's do the bond market and then I'll come back to the dollar. Now, if you remember, and I know you do, okay, what I said last night and probably 3 or 4 days this week was this big down candle here, we were making a wedge pattern. I said, if we can close hourly above, okay, the high of 156.02, then we would go to 157. Now, let's go to the hourly chart. Okay, here's the hourly chart. Okay, 156.02 was right here. Okay, so we closed above 156.02 and ran immediately to 157, okay? So, well, it happened in the hour, but you get the point. 156.02 brought 157 and then some, and there's probably higher prices coming as the market remains under pressure. That was an obvious one. So above 156.02, 157 and then some was in the cards. So that was a good, trade if you can catch it, if you got it, if anybody trades bonds, I don't know. But that certainly puts the pressure in yields. And so what the yield market is telling us now, and this is the 30-year yield, and look where it's coming, right into the resistance, support level that I've got drawn in here, and will probably come there on Monday. This is a gap fill area. It's a natural support area, okay? Look for the market to come into that and then have some kind of a reactionary bounce. But the yield market is now telling us, at least if you just want to interpret what yields are saying, yields are telling us, that, pardon me, that the Fed's not going to raise rates. That's just what the yield market is telling us. It's what the bond market is telling us. Whether they do or not is anybody's guess. I have my thoughts, but I don't know what they're going to do. Nobody knows what they're going to do except them. And okay, so let's go on to the dollar. The dollar. We have to talk about the dollar. So the dollar is failing, right? So we talked about the 50% retrace. We tried to rally. We got back to the 382, and now we're failing again. Most likely we go down to the 618. Similar to gold. I think it's a similar situation to gold. This is a pullback pattern off the larger move, okay? There's a lot of chart support in this area. Talked about it at least 3 times this week. Tons of chart support. When the chart hangs around these levels and bounces off these levels that are either resistance or support, remember, resistance becomes support and support becomes resistance. And this lines up with the 618. This is telling you that once the dollar, if it does, when it does come down to this level, this is going to be a very, very good level of support. I think it's the very same scenario as gold. I think you get a positive reactionary or bullish bounce off this level. But for the longer term, there's nothing wrong with the dollar. If you just want to look at it from a long-term perspective and be pat long the dollar, look at this bullish pattern. There's nothing whatsoever wrong with the dollar. Big up move, sideways bullish consolidation. We're putting in a reversal pattern, a reversal bar in the month of December. We did it over here. I'm not worried about it. This is a enormously bullish pattern. It's going to take a lot for this pattern to fail. A lot. It's not going to fail. It's just not going to happen. I don't say that often. I feel pretty strongly it's not going to fail. Okay. Talked a lot tonight. That's about all I've got. Yeah, that's about everything. I think I gave you everything I got, everything I have, properly said. So with that, have a great weekend. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.